Market Recap. I'm Daniel.
And I'm Mira.
And, well, today is Thursday, April 23, 2026, and we are looking at a really massive macroeconomic tug of war right now.
Oh, absolutely. It's pretty intense out there on the floor today.
Yeah, I mean, on one side, you've got this escalating Middle East geopolitical anxiety, specifically, the Strait of Hormuz blockade.
Right, the energy shock fears are just dominating that side of the narrative.
Exactly. And then on the other side, pulling in the completely opposite direction, is this persistent, just cycle-agnostic strength of corporate AI investment.
Which is really proving to be an unstoppable force at this point.
It really is. So our mission for this deep dive is to break down exactly what happened in the markets today, why they reacted the way they did, and the underlying fundamental logic behind it all.
Right, because you really need that baseline to understand the environment you're operating against.
Exactly. But before we jump in, we do need to explicitly state that this deep dive into the sources is for market context and discussion only. It is definitely not personal investment advice or, an investment recommendation.
Yeah, please don't make trades just based on our discussion here.
Right. So let's jump right in. Session 1, what set the stage before the U.S. session?
Well, to really understand that, we have to look at the hangover from yesterday, April 22.
Oh, yeah, that definitely carried right over into today.
It did. So despite those brief hopes earlier in the week of a U.S. and Iran ceasefire, the one Pakistan was trying to broker, the reality on the water overnight was just unapologetically hostile.
Yeah, I mean, hope doesn't really do much against a physical naval blockade.
No, it really doesn't. The U.S. military was actively enforcing a strict naval perimeter. I mean, they were physically intercepting multiple Iranian oil tankers.
Wow.
And in direct response, Iran's Revolutionary Guards, they didn't just issue press releases. They seized ships and actively attacked vessels in the Strait of Hormuz.
And they severely damaged commercial bridges.
Yeah, exactly. And when commercial bridges take that kind of damage, shipping routes are fundamentally broken.
And when those routes are broken, that trapped crude oil directly hits European markets first.
Oh, instantly. We saw European money markets in the early trading hours just aggressively pricing in central bank rate hikes.
Right, because of the inflation fears from the oil spike.
Yep. They moved to fully price in 2 European central bank rate hikes by this coming December.
2 hikes by December. That's a really aggressive pivot.
It's a sharp acceleration from what we saw just a few days ago. They also priced in nearly 60 basis points of hikes in the Bank of England for 2026.
Wow.
And Daniel, this reaction was completely amplified by some economic data from the prior session. The German government officially downgraded its 2027 economic growth forecast to a mere 0.9%.
Let's just linger on that 0.9% figure for a second, because that is practically stagnation for an economic powerhouse like Germany.
It really is.
And the Bundesbank explicitly blamed structurally high energy costs and inflation. So if you are an investor looking at Europe this morning, you are staring down the barrel of classic stagflation.
Stagnant growth combined with rising prices,
right,
which is, the absolute worst case scenario for a central bank.
Right.
I mean, they have no good options when growth is dying, but inflation is surging.
Exactly. And I want to unpack this concept of an energy shock a bit more because it's sometimes misunderstood as just, gas costs more.
Right. It's so much bigger than that.
It goes so much deeper into the machinery of the market. I like to think of a structural energy shock as a mechanical tax.
Oh, that's a great analogy. A mechanical tax.
Yeah, because when geopolitical conflicts threaten oil supplies, that price spike at the pump mechanically feeds into broader headline inflation. It acts as this mandatory, undodgeable tax on every single consumer's wallet.
And it's a tax on the supply chain for every corporation, too.
Yeah.
It just eats margins alive.
Exactly. And because of that unavoidable tax, central banks are backed into a corner. To cool down that inflation, they are forced to hold policy rates higher for a much longer duration.
Which brings us to the actual mechanism of how this hits the stock market. Higher central bank rates push up the discount rate.
Right. And if you don't spend your days building complex financial models, just think of the discount rate like gravity for stock prices.
Gravity is the perfect word for it.
It's the mathematical formula used to figure out what future corporate profits are actually worth to an investor today. So when central banks raise rates, they're turning up the gravity.
Earnings that a tech company promises to make 5 or 10 years from now suddenly weigh a lot less today.
And the term we use for that on the floor is multiple compression. The price-to-earnings ratio of the broader market physically has to shrink to adjust for that higher gravity.
Yeah, and when you combine that mathematical pressure with the sheer uncertainty of global supply chains, which elevates the overall equity risk premium in a vacuum, risk assets should just sell off hard.
Right, and that was the grim stagflationary fear that global markets woke up to before the U.S. opening bell even rang.
They were definitely bracing for impact.
All right, well, that wraps up the overnight setup. We're going to take a really short break, and when we come back, we'll dive right into the U.S. Open.
Sounds good.
All right. Moving on to session 2, what moved markets during U.S. trading hours?
Well, the defining catalyst of the day hit the tape at exactly 2:31 p.m. Eastern Time.
Oh, yeah, I remember watching the screens right when that broke.
It was wild. Report confirmed that Iran deployed additional explosive mines in the Strait of Hormuz. This was a direct physical counter to the U.S. naval blockade.
And the energy markets just lost it.
They did. Crude oil spiked so violently the second that news hit. NYMEX WTI crude surged over 3%, and it settled at $95.85 a barrel.
That is a massive intraday move.
Right, and Brent crude actually topped $105.
A 3% intraday move for a massive global commodity like crude oil is just wild to watch in real time.
It really is.
And it completely contextualizes the intense political rhetoric we were hearing earlier in the day. Because around 8:45 a.m. Eastern Time, President Trump made some highly visible statements.
Yeah, the rhetoric was definitely dialed up.
Right, and we're obviously just impartially reporting on the statements here, but he vowed to shoot any vessels laying mines, and he claimed the U.S. blockade is 100% effective. He also made a remark noting that, well, while oil prices are currently high, he is actually relieved it hasn't hit the $200 a barrel doomsday scenario.
Yeah, and those statements really solidify the market's working assumption today. The primary choke point for a fifth of global seaborne oil is essentially sealed tight.
There's just no easy way out of this standoff.
Exactly.
But, here's where I actually want to push back a little on how the market and frankly, how a lot of financial media processes this kind of event.
Okay, how so?
There is this immediate reflex to treat Middle East escalation like a sudden, unpredictable natural disaster, like a hurricane or an earthquake that just happens to hit the market out of nowhere.
Right, just totally uncontrollable chaos.
Exactly. But if we actually look at this through a game theoretic lens, it is highly calculated. Both sides are strategically escalating right up to the very edge of mutual destruction.
Oh, that's an interesting way to frame it. Calculated brinkmanship.
Exactly. They are laying mines, intercepting tankers, making loud public threats. They are intentionally testing boundaries and signaling resolve.
So it's not chaos, it's a strategy.
I mean, the goal for either side isn't necessarily to trigger a catastrophic global total war. The goal in this game theory scenario is to create enough targeted economic pain and leverage to force diplomatic concessions.
It's a high-stakes game of chicken.
It really is. But for the market, trying to price the exact moment that game of chicken ends or miscalculates is what creates this incredible intraday volatility.
And yet, despite that volatility, despite the surging price of crude oil and the specter of $105 Brent, U.S. equities actually absorbed the blow remarkably well.
They really did hold up.
And the reason why lies hidden in the domestic economic data. At 9:45 a.m. Eastern Time, the S&P Global Flash US PMI was released, and it beat expectations across the board.
Oh, right.
Yeah, the composite PMI came in at 52.0, and manufacturing was notably strong at 54.0. And keep in mind, in PMI data, anything over 50 indicates actual expansion.
So while Europe is officially downgrading its growth and bracing for stagflation, the U.S. factory floor is actually accelerating.
Exactly. And it wasn't just manufacturing flashing green either. Earlier in the morning, at 8:30 a.m. Eastern Time, initial jobless claims came out.
And they were low, right.
They remained incredibly low at just 214,000. So when you combine a historically stable labor market with actively expanding business activity, you get a really resilient foundation.
So that robust domestic data essentially built a concrete floor under a market that was otherwise getting battered by the oil spikes.
Exactly.
It's like U.S. economic resilience acting as a macroeconomic shock absorber.
That's a great way to put it.
We also saw another major narrative push midday that plays right into this theme of domestic strength. Around 3:46 p.m. Eastern Time, statements from President Trump and Commerce Secretary Lutnick hit the wires.
Oh, the semiconductor reshoring announcement.
Right. They were claiming an aggressive reshoring of semiconductor manufacturing away from Taiwan.
They projected a staggering $1 trillion in domestic chip fabs, claiming that tariffs and newly negotiated deals are bringing all the major semiconductor companies back to the U.S. and South Korea.
And I mean, if a structural shift of that magnitude actually materializes, it drastically reduces U.S. reliance on highly vulnerable East Asian supply chains.
It would be huge.
But wait, I have to jump in here because $1 trillion sounds amazing on a political press release, but building a semiconductor fab is not like opening a new warehouse.
Oh, not at all.
It takes 5 years, billions in initial capital, advanced lithography machines that are back-ordered for years, and incredibly specialized clean rooms before a single usable chip rolls off the line. So does a long-term projection like that actually help the markets today, or is that just political theater acting as a sentiment boost?
It's a really vital distinction to make. You are right that the timeline is immense, and it introduces massive near-term capital expenditure burdens for these tech companies to actually build those factories.
Right, they have to pay for it now.
Exactly.
Yeah.
The market might bid up the sentiment today, but the reality of funding those fabs will weigh on balance sheets for the next decade. It's essentially trading future capital drain for long-term supply chain security.
Which perfectly sets up the final market action we saw going into the close today, because it was an absolute roller coaster.
It really was.
The S&P 500 dropped to a sharp intraday low of 7046.55, absorbing the initial shock of those naval mines and the 2.31 p.m. news.
Yeah.
But then it just clawed its way back, leaning on that domestic data to close down just 0.4% at 7118.40.
That resilience is wild.
And the Nasdaq closed at 24438.40, while the VIX, the volatility index, popped slightly to 19.31.
That price action is basically the physical manifestation of the tug-of-war we mentioned. Geopolitical energy shocks and inflation fears pushing down, while robust U.S. economic fundamentals provide buoyancy.
It perfectly sums up the U.S. trading hours. All right, we'll take another short break, and then we'll get into the corporate-specific moves.
See you in a minute.
And that brings us to session 3, corporate events recap and what to watch next.
So as we said, the macroeconomic data is only half the story keeping the Nasdaq afloat.
Right, because if resilient U.S. economic data was the floor, corporate artificial intelligence infrastructure is the absolute rocket engine carrying the market forward.
It really is. This brings us to the corporate side of the equation, which is where the real counterweight to that multiple compression we talked about earlier lies.
And honestly, nothing highlighted the sheer scale and ruthlessness of this AI infrastructure boom better than the bombshell we got from Meta today.
Oh man, that hit at 1:35 p.m. Eastern Time, right during U.S. trading. Meta announced it is cutting 10% of its entire global workforce.
10%?
Yeah. We are talking about roughly 8,000 actual employees losing their jobs and an additional 6,000 open roles being permanently eliminated.
A 10% cut at a company of that size is massive.
Yeah.
But the why behind it is the most fascinating part of the day.
Exactly. Because they didn't point to a drop in user engagement or, failing ad revenue.
No, they explicitly stated that these deep job cuts are a push for efficiency to help offset their massive ongoing AI infrastructure investments.
Yeah, they're literally gutting their operational workforce to fund their server ambitions.
It just reveals the mind-bending capital requirements of the AI arms race. These tech hyperscalers are essentially rewiring their entire balance sheets in real time.
They absolutely are. They are firing thousands of talented engineers and managers just to afford the electricity, the cooling systems, and the data centers required to stay in the game.
It really proves that AI capital expenditure isn't just, an experimental side project anymore. It is an existential priority for the survival of the business.
Right. If you don't build the infrastructure, you lose the future.
Exactly. And if we want to step away from the digital realm and look at how this AI arms race impacts the physical world, we just have to look at the morning earnings call from Freeport-McMoRan.
Oh, that call was fascinating. It happened at 10:14 a.m. Eastern Time. And for listeners who might not crack commodities, Freeport is a global copper giant.
Right. And on their call, the CEO attributed the surging U.S. demand for copper directly to AI data centers and the related power grids needed to support them.
Yeah, which makes so much sense when you think about it.
It does. You might think of the cloud or AI as this invisible, abstract software network floating above us, but the cloud is highly physical.
It's incredibly physical.
It is a massive concrete building full of hot servers, and those servers run on incredible amounts of electricity. And to get electricity from a power plant to those specific server racks, you need step-down transformers, specialized substations, and just miles and miles of heavy-duty copper wiring.
Yeah, copper essentially serves as the literal physical bottleneck for our digital AI dreams.
Making that connection between digital ambition and physical constraint is so vital right now.
It is. Copper is becoming a highly reliable proxy for physical AI infrastructure growth. If Freeport is seeing a sustained surge in demand, it means the physical build-out of the AI boom isn't just a projection on a whiteboard.
It is actively happening right now.
Right, and the scale is historically massive.
It also means we are very likely going to see secondary inflationary pressure in raw industrial materials as that supply tightens. When the tech sector demands all the copper, the price of everything else that uses copper goes up.
Oh, absolutely.
But to cap off the corporate narrative today, we got a major fundamental bellwether right after the bell.
Yes, at 4:01 p.m. Eastern Time, Intel released its first quarter earnings.
And they delivered.
They really did. Intel reported strong double-digit year-over-year growth in their AI and data center businesses.
Which is huge.
And furthermore, their management team provided forward guidance stating they fully expect that double-digit expansion to continue through the year.
This is exactly the validation the market desperately needed to hear today.
It justifies the hype.
It validates the massive capital expenditures that companies like Meta, Microsoft, and Google have been announcing over the past few sessions. Because if Intel is successfully selling the chips in those quantities, the physical build-out is generating real revenue.
Exactly. It provides a cycle-agnostic growth engine that is, at least for now, insulating tech earnings from the macroeconomic headwinds blowing out of the Middle East.
It's the primary reason why the market's elevated valuation multiples haven't crumbled under the weight of higher interest rate expectations today.
It really is.
You know, the juxtaposition of these two realities, cutting-edge AI, wealth creation against the backdrop of explosive naval mines, is just staggering.
It's surreal.
It is. And there is a scripted joke from our source material today that perfectly encapsulates the mood on the trading floor.
Oh, I've got to hear this.
Okay, it goes like this. Today really proved you either need to be drilling for oil or building AI data centers with absolutely no in-between. Meta is cutting 10% of its workforce just to pay for its AI electricity bill, while crude is surging so fast that President Trump is actually relieved it hasn't hit $200 a barrel yet. But hey, your portfolio survived another wild day of global blockades and explosive naval mines. So go ahead and pour yourself a celebratory drink to unwind tonight. Just make sure it isn't crude oil because you definitely can't afford it.
Oh, wow. That perfectly sums up the absolute absurdity of navigating the current market environment.
It really does. So as we close the book on April 23, what is on the calendar for tomorrow, April 24? What do you need to be watching?
Well, we have a busy morning ahead of us tomorrow. Between 8:30 and 10 a.m. Eastern Time, we will get pre-open earnings from Procter & Gamble, HCA Healthcare, Schlumberger, Norfolk Southern, and Charter Communications.
That's a lot of ground to cover.
It is. Those reports are going to give us a key read-through for defensive consumer stocks, the transport sector, and energy.
And then there's the data release at 10 a.m., right?
Yes. Right at 10 a.m. Eastern Time, the University of Michigan will release its final April consumer sentiment data, which crucially includes long-term inflation expectations.
And that specific data print often causes rapid moves in the U.S. dollar, treasury yields, and gold.
It definitely does.
So the tug-of-war continues tomorrow morning.
It never really stops.
As you digest this mountain of geopolitical and corporate data tonight, we've spent a lot of time talking about how corporate earnings in the tech sector seem practically immune to the normal business cycle right now, all because of this massive AI infrastructure boom.
Right.
But here is a final provocative thought to mull over as you watch the markets open tomorrow. If copper is the physical proxy for AI development and energy is the fundamental mechanical tax on everything, what happens to these massive tech valuations if the physical constraints of reality like severe copper shortages or structural energy bottlenecks force that AI spending to hit a brick wall before the Middle East conflict is resolved?
We would love to hear your thoughts and theories on how that collision course plays out in the comments below.
Thanks for joining us for this deep dive today. We'll see you next time.